Hey there, stock enthusiasts! This is Brian Adams from Informate. Are you ready to dive into the exciting world of investing? Before you jump in, it's important to make sure you're buying stocks in a safe and smart way. Don't worry, I've got your back. With my insider tips and tricks, you'll be a pro in no time. So grab a notepad, a coffee, and let's get started on the journey to secure stock purchases. Remember, slow and steady wins the race, and with these safe buying strategies, you'll be on your way to financial success in no time. Let's go and see what is the most important tips to buy a stock in safe way. Tip number 1: conduct thorough research. The first tip to buy safe stocks is to conduct thorough research. This involves carefully evaluating the company and its financials, products, and management to determine its future growth potential. When researching a company, some important factors to consider include 1. Financials. Analyze the company's financial statements, such as its balance sheet, income statement, and cash flow statement, to get a better understanding of its financial health. 2. Products. Research the company's products, including its product line, market share, and growth potential. 3. Management. Evaluate the company's management team, including its leadership, experience, and track record of success. 4. Competition. Research the company's competition and determine if it has a competitive advantage. 5. Industry. Evaluate the industry as a whole, including its growth potential and future outlook. By conducting thorough research, you can get a better understanding of a company's strengths and weaknesses and make an informed decision about whether it's a good investment. It's important to consider all available information and to consult with a financial advisor if necessary. Tip number 2: diversify your portfolio. Diversification is a key component of investing in a safe and secure manner. When you diversify your portfolio, you spread your investment across different assets, industries, and geographic regions, reducing your overall risk. Here's how you can diversify your portfolio. 1. Invest in a variety of asset classes. This can include stocks, bonds, real estate, commodities, and cash. 2. Spread your investments across different industries. For example, you can invest in a mix of technology, healthcare, finance, and consumer goods companies. 3. Geographical diversification. Investing in companies from different countries can provide exposure to a variety of economies and reduce your risk if one country experiences economic turbulence. 4. Consider actively managed funds. An actively managed fund, such as a mutual fund or exchange-traded fund, ETF, can provide diversification within one investment. It's important to remember that no investment is completely risk-free, but diversification can help you manage risk and potentially improve your long-term investment results. Tip number 3: look for a strong balance sheet. A company's balance sheet is a snapshot of its financial health at a specific point in time. It lists the company's assets, liabilities, and shareholder equity. A strong balance sheet is a sign that a company has a solid financial foundation and is less likely to experience financial difficulties. Here are some factors to consider when evaluating a company's balance sheet. 1. Assets. Look for companies with a healthy mix of liquid assets, such as cash and marketable securities, and long-term assets, such as property, plant, and equipment. 2. Liabilities. A company with low liabilities is generally considered to be in a stronger financial position. Pay particular attention to short-term debt, as this is debt that must be repaid in the near future. 3. Debt-to-equity ratio. This ratio measures the amount of debt a company has relative to its equity. A low debt-to-equity ratio indicates that the company is financing its operations primarily through equity rather than debt, which is generally considered to be a positive sign. 4. Current ratio. The current ratio measures a company's ability to pay its short-term debts using its current assets. A current ratio above 1.0 indicates that a company has enough liquid assets to cover its short-term debts. By carefully evaluating a company's balance sheet, you can get a better understanding of its financial stability and risk level, and make more informed investment decisions. Tip number 4. Check the cash flow. Cash flow is the money a company generates from its operations, which is crucial for a company's long-term survival and growth. A positive cash flow indicates that a company is generating more money than it is spending, which is generally a sign of a healthy business. Here are some factors to consider when evaluating a company's cash flow. 1. Operating cash flow. This measures the cash generated from a company's core business operations. A positive operating cash flow indicates that a company is generating enough revenue to cover its operating expenses. 2. Free cash flow. This measures the cash a company has left over after accounting for capital expenditures, such as investments in property, plant, and equipment. A positive free cash flow indicates that a company has enough cash to invest in its growth and pay dividends to shareholders. 3. Cash flow from financing activities. This measures the cash a company receives from financing activities, such as issuing bonds or taking out loans. A company that relies heavily on financing activities to generate cash may be considered riskier than a company that generates cash from its operations. 4. Cash flow trends. It's important to look at a company's cash flow over time to see if it is consistently generating positive cash flow or if there are fluctuations. By evaluating a company's cash flow, you can gain insight into its financial stability and ability to pay its debts and invest in growth. A company with a consistent and positive cash flow is generally considered to be a safer investment. Tip number 5. Consider the dividend history. Dividends are payments made by a company to its shareholders, usually in the form of cash or additional shares of stock. A company's dividend history can provide valuable insight into its financial stability and ability to generate consistent earnings. Here are some factors to consider when evaluating a company's dividend history. 1. Consistency. Companies that consistently pay dividends are generally considered to be more financially stable. A consistent dividend history can also be a sign of a company's commitment to returning value to its shareholders. 2. Growth. A company that has a history of increasing its dividend payments over time is generally considered to be in a strong financial position. 3. Yield. The dividend yield is the annual dividend payment divided by the stock price. A higher yield can indicate a more attractive income opportunity for investors. 4. Payout ratio. The payout ratio measures the percentage of earnings that a company pays out as dividends. A low payout ratio can indicate that a company has room to increase its dividend payments in the future. By evaluating a company's dividend history, you can get a better understanding of its financial stability and ability to generate consistent earnings. Companies with a strong dividend history are generally considered to be safer investments. To wrap things up, always keep in mind that investing in stocks can be a great way to grow your wealth over time, but it's important to do your research and consider multiple factors before making any investment decisions. By following these tips and staying informed, you'll be well on your way to building a safe and secure investment portfolio. And that's a wrap. I hope these tips have been helpful in your quest to buy safe stocks. As always, make sure to do your own research and consult with a financial advisor if you have any questions. Happy investing! Thank you for watching us.